ये सब्जी का झोला मेरी जान लेके जाएगा, टैक्स में छूट लाइफ आसान बनाएगा, ऐसा मेरा ख्वाब है सस्ता लोन मिल पाएगा, किचन का राशन भी सस्ता दूध दिलवाएगा।
बजट के इस चांस में सितारा मन फाइनेंस में हम मुश्किलें हटाएंगे, बजट तेरा बनाएंगे, सरकार बनी पसीने से मजा बड़ा जीने में। क्यों? क्योंकि तेरा बजट आएगा, तू खाली हाथ आया था झोली भर के जाएगा।
So that was an excellent cartoon song featuring the Prime Minister and the Finance Minister. Union budget is going to be an interesting chapter, unit number 19. So this chapter will basically revolve around what is a revenue expense, what is a revenue income, what is capital deficit, and 1 rupee for Government of India, what are the sources for it, 1 rupee expense for Government of India, what are the heads for it. So all these macroeconomic items are going to be discussed in this unit. Annual budget of a country is called Union budget because it is presented by the Union government. And earlier there was a concept where rail budget used to be presented as a separate budget. You can see Lalu Prasad Yadav presenting it many times. And Lalu's budget, railway budget, it was even discussed in many big MBA universities, management universities abroad like Cambridge also, because there were scenarios where the railway fares were not increased, but the total revenue for the railway ministry was increased. So that was one master stroke of Lalu Prasad Yadav because he increased the total number of footfalls. So like that, railway budget has a great significance, but of late there is no separate railway budget. On February 1, along with the union budget, railway budget is also a part of the union budget. It got merged with the union budget. So it is presented by Finance Minister of India, Nirmala Sitharaman. You got to understand certain things like receipts minus payments equal to surplus. Now surplus comes when receipts are greater than the expense or the payments that Government of India does. If it happens in the reverse fashion, then we call it as deficit. If the payments are more and the receipts are less, then that will give a negative impact, and that negative impact is called as deficit. Total expenditure minus total revenue is equal to fiscal deficit. The fiscal deficit is usually expressed as a percentage of a nation's GDP, and if it is very minor, then it's quite healthy. Sometimes this fiscal deficit used to be huge. But should we always fear when fiscal deficit is so huge? Not necessary, because when we make investments, when government does investments, basically it invests on the countrymen's welfare or the infrastructure welfare, which will reap its benefit in 5 or 10 years down the lane. In that angle, revenue deficit or fiscal deficit need not be given too much importance because it is a fuel for the future growth of the country. Now let us see what are the receipts for Government of India. See, the receipts are basically categorized into tax revenue and non-tax revenue. Tax revenue includes the gross tax revenue, which is coming as corporation tax, income tax, service tax, excise duties, and taxes of union territories. Taxes of union territories is different from taxes of individual states. In that angle, the taxes of union territories will be only added as a gross tax revenue, and the repayment is very meager and minor. Now let us see what net tax revenue is. From this gross tax revenue, if you subtract the amount transferred to NCCD, NCCD means National Calamity Contingency Fund. Whenever a tsunami happens, earthquake happens, flood happens, Government of India spends for the individual states and union territories. That fund is collected from National Calamity Contingency Fund. In Tamil, we call it as Desiya Peridar Kalanidhi. This NCCD amount will be subtracted from gross tax revenue. And in addition to that, the state's share of tax is also subtracted from it. Hence, the gross tax revenue will become net tax revenue. So, net tax revenue, NTR equal to gross tax revenue minus NCCD fund minus state's share. Of late, you can see some news about the complaining from states, especially non-BJP states, stating that we are giving a big share to the union government, whereas the state share is not given back properly. Especially states which are considered as manufacturing hub and services hub, they will have this problem. Now, what are the non-tax revenues? Non-tax revenues are dividends and profits, external grants, and receipts from union territories, interest receipts. If you are a nationalist banker, what you can see, your bank will give this dividends to Government of India. And you are watching a picture now. In this picture, Bank of Maharashtra's MD and ED are handing over the dividend of Bank of Maharashtra to Honorable Finance Minister. Like that, PSEs, like LIC used to give a big dividend. LIC is a hoofing contributor for dividends with respect to the total non-tax revenue of Government of India. So these are the avenues through which government collects the receipts. For a 1 rupee collection, the income comes from corporate tax, income tax, union excise duties, GST, non-debt capital receipts, borrowings, etc. So this is how a revenue receipt is categorized. Now let us see what are capital receipts and how are they calculated. Capital receipts is equal to sum of non-debt receipt and debt receipt. Now let me explain the difference between capital receipt and revenue receipt. Revenue receipt is a result of a profit or revenue that happens due to a running business, whereas a capital receipt is a receipt or an income that is happening due to a sale of capital asset, a repayment of capital that is already invested. Now these are not items which are coming due to daily running of business. So in capital receipt we have two types, non-debt receipt and debt receipt. Non-debt receipt is this disinvestment receipts. When Government of India reduces its stake from a public sector enterprise, then that stake will be sold to some private players. The private players will give cash to the government and that will come as disinvestment receipts. Recoveries of loan and advances which is already given. One good example is, now the Chinese government is putting huge pressure on Sri Lanka because Sri Lanka was aided by debt from China. Likewise, India has given loans and advances to many countries, and when we do a recovery of those loans and advances which were earlier a part of a debit entry in our capital expenditure, now those things will be accounted back as capital receipts. These are called as non-debt receipts. With respect to debt receipts, Government of India issues T-bills and government securities, and even a common man can purchase these T-bills via RBI Retail Direct. It can even be done through Zerodha, and these T-bills are basically borrowings from the citizens for infrastructure developments, for renewable energy developments, etc. And these will be repaid to the countryman after a particular time. These kind of borrowing receipts are called as debt receipts. It includes state provident funds, external debts, security against small savings. Against NSC, National Savings Certificate, people can get loan. And that loan, when it is repaid, that repayment will be a part of the debt receipt. So the capital receipt, the bigger figure, is a summation of this non-debt receipt and debt receipt. Now let us see the primary differences between capital and revenue receipts. Capital is the amount received by sale of fixed assets or receipt from a loan taken, whereas revenue receipt is the amount realized by sale of goods or rendering of services. Capital receipt is shown in balance sheet and revenue receipts are shown in profit and loss account. If you are a loan manager giving loan to a MSME, you will basically ask these things from the MSME owner. Sir, give last 3 years, balance sheet, P&L, IT returns, etc. P&L shows the profit and loss of the company, balance sheet shows the capital resource the company has. Capital receipts are usually non-recurring in nature. Say for example, when government sells a particular PSE stake, like BSNL, it is not going to sell it every January. It will be a one-time event. Whereas revenue receipts are usually done by sale of goods or rendering of services, which is a recurring event. Hence, capital receipts are non-recurring, revenue receipts are recurring. Capital receipts are not received in course of normal business activity, as I already said. Exceptional activities like selling of an asset or collecting back of a loan, that is the contributory factor for capital receipt. Whereas on the other hand, revenue receipt, it is received in the course of normal trading operations. Now, capital receipts cannot be taken as a profit by the owner, whereas revenue receipts can be taken as profit by the owner. We have seen about the receivables. Now let us see what are the expense for the Government of India. Expense, we can categorize them as non-plan expense and plan expense. Now these non-plan expense and plan expense are common even in our households. The rent that we are paying to our landlord is a plan expense because we know what is the rent amount and what is the date it has to be affected. Suppose our gas cylinder depletes on a particular day and we need to book a new cylinder which we never knew when it will happen. Those kind of activities are non-plan expense. Government of India do have non-plan expense. For example, the calamity fund, which will be depleted whenever some natural calamity happens. Now that's a part of non-plan expense. Plan expense is something which we do for the development activities, socio-economic reforms. Those things are plan expense. Now the total expenditure is equal to total plan expense plus total non-plan expense. Let us see what revenue deficit is. Whenever the word deficit comes, it means the expense is more than the income. So, revenue expenditure minus revenue receipts will form the revenue deficit. If you further streamline this revenue deficit, we will call it as effective revenue deficit. In effective revenue deficit, what we do is, the borrowing to the capital expense will be adjusted against the revenue deficit. Sir, you explained earlier like capital is different, revenue is different. Now, why capital expenditure has to be accounted on revenue deficit? If you ask a question like this, I will quote Dr. C. Rangarajan's example. You know, Rangarajan sir was a RBI governor and he is the founder member of Madras School of Economics, which we see in Guindy, Chennai. Why this is happening is, whenever we do a capital expenditure, the interest on basis of loans borrowed for that expenditure, that will be taken from a part of the profit. Hence, the impact of a capital expenditure made through loan will have a considerable effect on the profit and loss book as well. To that extent, when we subtract the grants in aid are the basic contributions in form of loan for capital expenditure. When we subtract this grants in aid from the revenue deficit, we will get actual effective revenue deficit. Now what is fiscal deficit? Fiscal deficit is expense minus revenue. Total receipts is total revenue receipts plus capital receipts plus drawdown of cash balance. What is the cash in hand? That has to be also considered for accounting the total receipts. And primary deficit is fiscal deficit minus interest payments. Now these small formulas, please make a note because you will get numerical problems with these minor formulas. Now this is how Government of India spend a single rupee. The header percentages are mentioned here. Central sector scheme 17%, interest payment 20%. And moving forward, I feel this pension area will reduce because defined contributory pension scheme, DCPS we call. NPS is a form of DCPS where the employees contribute their own fund for their future pension. Now this will reduce the burden on the exchequer. Look at here friends, pensions form 4% of government expense. Now Rajasthan state government did one thing. They switched back from NPS to the old pension scheme. Rajasthan is one state that has gone back and adopted this old pension scheme. Other than Rajasthan, even in Tamil Nadu we have the new pension scheme formula only. People contribute it from their pocket and government will make a considerable contribution as well. And finally at the end, the pension, what the people get is out of the contributions they made during their lifetime. Let's see some numerical problems. Tax revenues 25,16,059. NCCD, the National Calamity Contingency Fund, is 6,130. State share of tax revenue is 7,44,765. Found out the net tax revenue. All we need is the formula only, my dear friends. Net tax revenue is nothing but tax revenue minus the calamity fund wala and share of tax revenues for the states. If you do that, we will arrive at the final answer 17,65,164. Let us continue the same sum with an additional fact. If the total non-tax revenue is 3,13,791, what will be the total revenue receipt? We have already calculated the net tax revenues in the last question. To that, if we add the non-tax revenues also, that is the 3,13,791, we will get the total revenue receipts, which is 20,78,936. And let us continue the same question. If capital receipts were 15,16,877 and total receipts were 37,70,000, find out the cash balance. Total receipt is nothing but total revenue receipts plus total capital receipts plus drawdown of cash balance. Drawdown of cash balance is to what extent the cash balance has been reduced. So it's a simple algebraic equation. All the questions will be like this. Out of 4 items, they will give 3 items and you need to find that one item. So by making this LHS, RHS calculations and equations, you can get the item which is not present. Only thing that has to be carefully monitored is these signatures. Note the plus and minuses involved. The 2 plus, when they go to the other side, they will become minus. People, if you are confident on the logic part of how a formula is arrived, then you will never make mistakes. So the answer is 1,74,187. That is the cash balance. So let us continue the same question. If Centre's total expenses 37,70,000, revenue receipts are 20,78,936, capital receipts is 99,978. What is fiscal deficit? Fiscal deficit is total expense minus total revenue. Total revenue can be found out by adding these two things. So add these two things and subtract that amount from the expenditure. So that is what is being happening here. And the final value is 15,91,089. That's the fiscal deficit. And let us have same question. Total revenue receipts were 20,78,936. Revenue expense is 31,67,289. What is revenue deficit? When the word deficit comes, always expense is more than the income. Now the expense is this amount, income is this amount. Subtract them, simple max, you will get the answer. And in the above problem, if we add a factor called grants in aid I have already explained. Whenever a capital expense is done via a loan, then it has to be subtracted from the revenue deficit so that we will arrive at the exact value of effective revenue deficit. This math, if you apply, you will get this answer 8,50,668. And if fiscal deficit was 15,91,089, interest payment were 8,13,000. What was the primary deficit? See, primary deficit formula we have seen already. It is fiscal deficit minus interest payments. Be very careful in these minus and pluses only. Now all the problems that we calculate, if you know the first formula, the answer is quite an easy cakewalk. If you make a mistake in this minus and plus, that mistake the answer will also be a part of the option. Say for example, here I am subtracting 813,791 from this big number. Instead, if I forget and add it erroneously, I will get an answer. That answer will also be placed in one of your answer options. So if you make a mistake in the sign, that's all, you will land up at the wrong answer. So the right answer is, difference between fiscal deficit and interest payments is 7,77,298. So that's all for this chapter, friends. Let us meet in a new chapter.